Welcome to this week's edition of Weigh the Options. Weigh the Options is a video series where I take a look at 5 potential options trades for the week. Now do note that Weigh the Options is a members only video series where members of the channel get immediate access to the video. If you're not a member of the channel, you have to wait 1 week before the video is made publicly available, so please consider becoming a member of the channel. Click the join button down below to become a member. It's only $5 a month and you get immediate access to all of my content, including Weigh the Options, and it helps support the work I do on this channel. So let's talk about some of the trades I'm thinking about for this week. The very first thing I'm thinking about is it's a really ugly week in the market this past week, and because of that, volatility is through the roof. Right now, of the major market indices, the Russell 2000 is the weakest. It's the one that has the highest volatility. So I'm thinking about doing something in IWM, right? Because it has good volatility. It's a perfect time to go sell some premium. And I think the way I want to play this is with an iron condor. So for me, I would go somewhere around, let's go 19 deltas and go $5 wide here on the put side. So I sold the 19 delta put and then I bought the put $5 below. This is an 85-cent credit on this put credit spread side. That's more than enough credit for me. That's actually very juicy. And again, because of the volatility, right? This is actually a really good price on just 1/2 of the iron condor. Let's go put on the call credit spread side and let's go to similar deltas, maybe the 18 delta, and then go $5 wide. And yeah, that brings us up from 85 cents to 155. So that added another 70 cents of potential profit on this trade. So the max profit is 155. That's the credit we receive. And then the max loss, because it's a $5 wide iron condor, $5 wings, $5 minus 155. The max loss is 345 on the trade. Now the pop, I don't think the pop is being reported correctly here. It says the pop is 59%. With the deltas we chose, that pop would probably be somewhere between 65 and 70%. The P50 number is probably going to be somewhere north of 80%. Right now it's reporting it's a 77% P50 number. I'm recording this on the weekend, so some of the data could be a little skewed here. But because of the volatility, you get great price. You get to make this iron condor really wide. If I go to the curve and analysis tool, IWM is trading at 242, and your short options here, your short put and short calls, are the 220 and the 270. So you've got 22 points of runway to the downside, and you've got 30 points of runway to the upside. So, I really like this. And I also like doing this small, right? A $5 wide iron condor. Of course, you can size it however big or small you want. But for me right now, I don't want to take any big chances. I don't want to go sell naked strangles, for example, in anything. With the market looking like it just wants to completely tank, I would be worried about the puts in a week like this upcoming week. I would also be worried about the calls because, when the market is in free fall, the rebounds sometimes can be violent on the way back up. So define your risk. Right now, I'm just trying to take safe trades, right? I don't want to take any extreme risk right now. The next ticker I want to take a look at is JETS, Jets, right? So Jets, of course, is your airline ETF, and the airlines have been in free fall because of rising energy prices, rising oil prices. Fuel costs are a big component to the airline industry, and when there's disruptions in fuel, it causes these stocks to tank. And I like playing the Jets ETF because it doesn't have single stock risk. You don't have to worry about earnings because the airlines, many of them will start reporting earnings in the next couple of weeks. So, let's go ahead and just take off earnings off the table because, now I don't have to worry about one stock, making some crazy move and blowing me out on a strangle or a put or a call. So I'm going to do JETS, Jets. And what I'm thinking is I'm going to be a contrarian. I know, when you see something rolling over like this, you're thinking, man, it could continue lower, and it certainly could. But I do notice that, it fell hard. And then in the last week, it looked like it found a floor. And, I think this move is overblown. I think At some point, it will go back up. We just need to make sure whatever trade we put on, we give ourselves plenty of time. I'm thinking about just selling some puts. I'm thinking these 19 delta puts here at 55 DTE, really wide bid-ask spread. Again, I'm recording on the weekend. If we go to the 26 delta put, the bid-ask spread's much tighter, 95 cents by 105. That's a $1 credit on a 26 delta put on a buying power reduction of only 272. A pop on that trade would be 69%. The P50 is 83%. Just a fantastic trade, especially if you don't mind taking shares of Jets. If the stock keeps going down, you just take shares. Take 100 shares of this thing at $22 a share. Well, really $21 a share because you got a $1 credit for selling the put option. So you're taking shares of Jets $3 lower than where it's currently trading, which is a pretty steep decline in this particular $24 ETF. Now, realistically, 26 deltas is not where I like to play. I would much rather sell this 19 delta put. Realistically, I would think a fair price for that is somewhere around 70 to 80 cents. The bid-ask spread's kind of jacked up right here. But if I could sell that for around 70 cents and maybe sell two of them for $1.40 on a buying power reduction of $400, that's exceptional risk reward. Or three of them, now I'm getting more than $2 credit, a little over $2 credit on a buying power reduction of $600. The pop 75%, the P50 number 86%. And this is a really high probability, safe kind of trade. And again, because you don't have that single stock risk, you don't have that earnings risk. And if you don't mind taking the shares, so should something crazy go against you, which for me, taking shares of a sector or an industry ETF is never something that I fear, because if you hold it long enough, those things are practically guaranteed to eventually go back up. The next ticker I want to take a look at is MS, which is Morgan Stanley, because the financial sector has been beaten up lately. You can see Morgan Stanley is also suffering from that, right? It's been trending lower for about 3 months, right? Since the beginning of the year, it has been stair-stepping down. What would I want to do in this? Well, for something that's been slowly stair-stepping down, I think a put ratio spread makes a lot of sense. It has IV rank of 46, has earnings April 15th, but that's still far enough away that I don't mind putting on a trade right now. And for me, I would go buy a put debit spread. Let's go buy the 22 delta put and then sell the put $5 below. We pay about $1. So if we pay $1 for a $5 spread, the max profit's $4. So I like that. And then you just double up that 17 delta short put, and overall you get a 239 credit on the trade. 239 is what you make if we never fall below 145. Now, if we fall below 145 and get inside the spread, we have $5 of extra profit potential because of the $5 wide put debit spread. So the max profit's actually not 239, it's actually 739 if you finish exactly at the 2 short strikes on expiration, which is a very unlikely event. I would never hold this all the way to expiration anyway, because there's assignment risk. So I would get out of the trade at least, a few minutes before expiration on Friday, 55 days from now. I'm never trying to hold to expiration, but typically I'm really just trying to get 50% of the credit received on the trade. And you can see that's going to happen 90% of the time, right? The pop on this trade's 84%, the P50 number's 90%. We're getting a buying power effect of $1,500 and a credit of $239. So, risk reward is okay. It's not great, but it's not bad either. I like the risk reward as far as buying power versus credit. And then the probabilities are absolutely fantastic. So for me, all signs point to go on this trade. The next ticker I want to take a look at is Newmont Mining, NEM. Now, the reason we want to take a look at this is because the gold miners have been in full-blown crash mode. I mean, we saw a pretty serious event on Thursday this past week with Newmont. It was down more than 10% on the open, right? It had a huge gap down. The gold miners are badly beaten up, and Newmont is the largest gold miner. It's the largest component of the GDX ETF for those that play that. So, Newmont right now, because of the big move down, has extremely high IV rank, an IV rank of 81. And when you have that kind of IV, my first thought always is to sell a strangle, because that's your best bang for your buck as far as selling premium. You sell a put and a call, get double the premium for about the same buying power, because you don't get double charged on the buying power, whichever one has the highest buying power, either the short put or the short call. That's the buying power for the whole trade. So for Newmont Mining, has earnings on April 22nd, plenty of time. I don't mind putting this on right now. And we could go way out of the money because of the extreme volatility. We could go to the 11 Delta put, which is the 75 put in the 55-day cycle. And we could go and do maybe a 13 Delta call, and this is the 125 call. Overall, we get a 258 credit on a buying power reduction of $958. Just exceptional risk versus reward. The pop on the trade, because we're way out of the money because of the extreme volatility, we were able to do a really wide strangle and still receive a decent credit. The pop is 80. The P50 is 90%. Again, it's another trade. All signs point to go. And then finally, one stock that is a bit of a meme stock, and I mentioned I don't want to take any serious risk in the market right now. Let's take a look at SanDisk, SNDK. So a bit of a meme stock. It's gone from trading at $40-something a share to over $700 a share, right? Clearly, that's a meme stock. I would absolutely never sell any naked options in something like this. And because of that, well, let's do spreads, right? I want to be bullish because I don't think this memory thing is over. I think memory shortages, memory demand is still going to be high, at least for the foreseeable, short term. So you got to be bullish. So let's price a put credit spread. I'm going to go to the 55-day cycle. IV rank is 55. The IVX is 102%. So I bet we can get pretty far out of the money here on a put credit spread and still get decent premium. Let's see what we would get for the 21 Delta and go $10 wide. Wow, that's insane. That is an insane price on that put credit spread. We get a 325 credit, which means on a $10 wide spread, 675 is the max loss. 675 risk versus 325 reward is a crazy good risk reward. And to be all the way out at 21 deltas on that short put, right? We're more than 100 points out of the money. We're 150 points out of the money. Now, again, it's a meme stock and it's very volatile. So that doesn't necessarily mean you can't lose on this trade. I mean, the market's saying, hey, there's some risk to this trade, but that's why we would define our risk. That's why we didn't just sell the 20 Delta short put. We did the put credit spread instead to define our risk. But the pop on this trade, 68%, really good. P50, 79%, really good. And again, that excellent risk reward, you're basically risking 2 to make 1 on this trade, which is about where you want to be on a put credit spread. And to be able to do that so far out of the money, you don't get opportunities like this very often. Now, this is a bit of a longer term play, out here at 55 days where I like to hang out for put credit spreads most of the time. I like putting them on around 60 days and then managing them at 21 days. If you're looking for something that's a short term play, and, you want to keep it small because this is purely a lotto ticket, I would do a weekly trade. So I would go to Friday expiration for this week. And if you want to play for an up move for this week, go to the expected move to the call side and sell that call. And then maybe go 25 point wide wings on a butterfly. Double up the short in the center. You pay $130 for the chance to make $23.70, right? So almost $2,400 because of the 25 point wings, right? This is a really low probability trade. Actually, not the pop on the trade is 15%, and we're only paying $1.30 for the chance to win $23.70. That's actually pretty attractive. Again, it's a lotto ticket kind of play. You're probably not going to win on it. Well, they're saying 85% of the time you're not going to win on it. And then 15% of the time you will win. What will you win? Well, you'll win something, $100, $200. Realistically, because of the really high max profit, realistically, you finish somewhere inside the spread. You're probably going to get a profit of $500 to $1,000, I think is a normal kind of expectation. If you really hit it out of the park and you're somewhere $5 either side of the 780 strike here of the center of the butterfly, you're probably looking at like a $1,500 to $1,800 kind of profit if you can hold this all the way till Friday. Don't let it expire. Get out of it about 15 to 30 minutes before market close because there will be assignment risk if you're inside the spread. So don't hold it and let it go to expiration, right? Get out of it early. But if you can hold it late into the day on Friday and you're somewhere near the center of this spread, this has the chance to be extremely profitable. And of course, there's no reason why you couldn't put on this trade and that put credit spread trade, right? You pay $1.30 for this lotto ticket play, put on the high probability put credit spread where you get 325 credit, right? Which kind of helps pay for this a little bit, assuming you win on the put credit spread, right? Sometimes you can think of trades that are, they kind of work together a little bit. You don't always have to have just one position in a ticker. Sometimes you can have multiple positions that kind of all work together. So that's it for this week's edition of Weigh the Options. Again, Weigh the Options is a members only video series. So if you're not a member of the channel, click the join button down below to become a member. Also, check out my book, The Super Wheel Option Strategy. This book is about one of my favorite option strategies, which is the wheel strategy. This book is published on Amazon. You'll find a link to the book in the description below. All right, guys. Peace.